Scholastic just reported $56.7 million of net income after losing $1.9 million the year before. $99.7 million of that came from selling its own headquarters. Strip the building sale out, and the year was a pre-tax loss. Operating income was $15.2 million, against $15.8 million last year. Here is the whole year in 5 lines. Operating income, $15.2 million. Interest cost, net, $11.2 million. Pension cost, $1.3 million. A $17.2 million loss selling an equity stake in a British publisher. And $99.7 million of gain on the sale and leaseback. That is how negative $1.3 million became $85.2 million. The number that measures the business barely moved. $15.2 million of operating income on $1.58 billion of revenue. That is a 1% margin, about a penny of operating profit per dollar of sales. And it is not new. $14.5 million in fiscal 2024, $15.8 million in 2025, $15.2 million in 2026. 3 years, 1 flat line. Split it by segment. Children's book publishing and distribution, which is book fairs, book clubs, and trade, earned $142.9 million on $964.2 million of revenue. International added $6.4 million. Education lost $4.1 million. Entertainment lost $16.1 million. And corporate overhead cost $113.9 million. Overhead eats 80% of what the book fair business earns. So where did the revenue go? Total revenue fell $43.6 million, down 2.7%. Education fell $42.2 million of that, 97% of the entire decline, down 13.6% to $267.6 million. The filing blames a continued challenging funding environment for schools. Meanwhile, book fairs, the business everyone assumes is dying, grew $27.7 million on higher fair count. Here is the transaction. In December, Scholastic sold its headquarters at 555 Broadway in Soho for $386 million, and its distribution center in Jefferson City, Missouri for $95 million. It leased both back 15 years and 20 years. Net proceeds, $452.4 million. It spent $265.9 million buying back stock and repaid $175 million of debt. The buyback was not cosmetic. Weighted average diluted shares went from 30.4 million in fiscal 2024 to 27.6 million to 24.2 million. And most of the buying happened late in the year, so the year-end count of 18.7 million is well below that average. Shares outstanding fell 25% in 1 year. There is a bill on the other side of that gain. Scholastic now owes $547.3 million in future operating lease payments. Lease right-of-use assets jumped from $103.9 million to $291.2 million. Rent already rose $8.4 million this year, and the filing says it rises again next year. The building is gone. The rent is permanent. Cash is where it gets uncomfortable. Operating cash flow fell 59%, from $124.2 million to $50.9 million. Some of that is one-time taxes on the property gain, $41.4 million, but capital and pre-publication spending was $66.3 million. Against $50.9 million of operating cash, free cash flow was negative. So what is it worth? Start with $37 million of net cash, and depreciation settling near $55 million a year. If the operating margin stays at 1%, EBITDA is around $70 million, and at 6 times that is roughly $24 a share. At 2.5%, about $39. At 4.5%, about $62. Implied values under stated assumptions, not price targets. The stock closed at $40.76 on July 27th, so the market is paying for a margin that more than doubles. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.